Bond yields hitting their highest level since the summer following Donald Trump's election win and just ahead of tomorrow's Fed decision. For more on where they might head from here, let's bring in Rick Reeder, BlackRock's Chief Investment Officer of Global Fixed Income. It's great to have you on such a huge day like this, Rick. Thanks for being here.
Thanks for having me, Scott. It's a big day, big night. It was a long night.
What's most on your mind today as you see all of these different asset classes rallying so heavily?
So it's pretty incredible. I mean, first of all, the results were incredible. It obviously raged on through the evening. But listen, the equity market. I mean, this was, if you think about the growth dynamics that are going to persist. You know, economy that's been already operating at a good level. The growth data that's going to continue to be good. You know, the propelling of the equity market's pretty incredible. And by the way, I mean, beneath the surface, the drop in volatility that you're seeing is pretty. You know, I would say, like, you can own equities when volatility drops. You can own some convexity in it. So that's been super exciting today. Obviously, the dollar, and then the shift to the yield curve has been pretty extraordinary. You know, we've been talking about on the show before. The front end of the curve, while yields have backed up, it still is carrying really well. So that shift in the yield curve has been, I think, rightly so, steepening out quite nicely.
I mean, did we just pour gasoline on the bull market and throw a match on it? I mean, what has actually happened here within the last, I don't know, 12 hours?
Yeah. So, I think the last time we were on the show, I said I don't really like multiples. But it feels like we're long and we like equities, but it feels like speeding down the highway to try and get to where you're going. It doesn't feel great, but it's probably going to keep going. And there are two things happening that I think are profound. One, the technicals in the equity market are extraordinary. The amount of cash that's out there, and you don't really have any sellers. You don't have any IPO market, and the buybacks are profound. So you have an amazing technical. And to your point, what was challenging is the multiples are aggressive. And you have to count on, to get to the forwards on these multiples, you have to count on significant earnings growth. Well, you just got a kicker of maybe nominal GDP stays considerably higher. And by the way, I agree with the commentary earlier. You got to keep nominal GDP up, and that's how you outrun the debt. But maybe we keep nominal GDP up, and then the earnings, U.S. companies are operating leverage machines on nominal GDP. And so you just got a nice tailwind from that.
Well, I mean, it's good that you agree publicly on television with your boss. He's the one who wrote the piece.
Yeah, so I do. And by the way, it's just straight math. If you say today, so the average cost of debt in the United States about just under 3.5%. If we keep nominal GDP above 4 to 5, you can actually, and then you think about, gosh, there are things we got to do around spending. There's other ways to actually create spend that's got some velocity to it if it's spent on infrastructure, et cetera. If you create that paradigm, it's the only way that you can actually outrun the debt problem in this country. We got to do a couple things. We got to end up reducing the debt, the spend. We got to get the interest costs down, and then ultimately, if you grow fast enough, I mean, it's just straight math that you can actually. But it's the only way. I mean, quite frankly, it's the only way to do it. That's not a pernicious impact on the economy. This idea that we'll just aggressively cut spend, send the economy in a tailspin, it's just, you don't get there.
In a remarkable financial insight moment that has caught the attention of investors and market analysts alike, BlackRock's U.S. head of thematic and active ETFs, Jay Jacobs, recently suggested a potential seismic shift in investment trends, one that could fundamentally redefine our understanding of infrastructure and cybersecurity landscapes. Are you intrigued? You should be. During an insightful appearance on CNBC's ETF Edge, Jacobs shared a forward-thinking perspective on the evolving AI wave, arguing that it remains in its nascent stages and could represent an exhilarating investment opportunity for those with a keen eye. BlackRock, a formidable presence in the financial industry, is positioning AI as a powerful catalyst poised to set unprecedented benchmarks for profitability and growth in the tech sector. And it's not merely about banking it all on the obvious mega-cap tech giants. There's much more than meets the eye, a captivating narrative that hovers above the bustling stock markets, ready to divulge its layers as the infrastructure of the future unfolds. Welcome back, everyone, to Investocracy.
But what do I do with the prospect of higher growth as we spin it now towards the Fed decision tomorrow and what policy is going to look like in 25? All of that obviously has the possibility of leading to protracted inflation, if not a pickup. So how should I think about the idea that, maybe they're not going to cut even nearly as much as we thought, because they're not going to be able to.
So here's the question. First of all, I think inflation, the descent of inflation has already happened. Like, we didn't think inflation was coming down much further or any further from here, no matter what. We think inflation is going to run in the mid-twos for next year. So we think the descent of inflation has come down. So if you're the Federal Reserve today, you think about, to me, it's a no-brainer in terms of, gosh, you got to get that funds rate down to 4. And if you get the funds rate, so you do a 25 in November, you probably do a 25 in December. Once you get the funds rate to 2, you got inflation at 2.5. And then there's a lot of policy evolution. There's a lot of things they're going to learn. And then you make a determination from there. I don't think it is that much of a challenge to get that rate down to a 4 level, which is still, I would argue, restrictive in many ways. But then it becomes, the question of do you execute the further cuts in the next year? And that becomes questionable. It's part of why I think the front end of the yield curve, which is pricing that today, it's like, wow, there's not a lot of downside in it. If you go further out the yield curve, and then you've got to count on inflation staying down, maybe the Fed cutting more, then it becomes a tougher trade. And again, why I think, owning 30-year treasuries, is a bet on term premium, bet on what we're going to do on the debt and the deficit, but you don't need to do it with the yield curve still as flat as it is, even though we've steepened somewhat.
The stock market's dynamics can often be likened to the thrilling unpredictability of a theme park ride where each peak and descent brings a whirlwind of excitement and challenges. This time, the talks of the market revolve around none other than Jay Jacobs of BlackRock. According to Jacobs, the AI adoption cycle is just beginning to gain momentum, and the buzz among investors is palpable, much like the eager anticipation before a roller coaster's precipitous first drop. Why, you ask? Because with the expansion of AI technology comes an urgent need for resilient data centers and an unwavering focus on cybersecurity. In the intricate game of stock market investments, a touch of humor can sometimes offer necessary perspective. Visualize data as an invaluable vault of secrets. Coursing through cyberspace, it's akin to a teenager's social media account, constantly refreshed, deeply treasured, yet intensely susceptible to threats. Recognizing this, Jacobs has underscored the crucial necessity of funneling more investments into cybersecurity as data continues to grow in value. Bolstering his claims, current market data and trends reveal brisk revenue growth within the cybersecurity and software sectors, a clear reflection of AI's burgeoning influence. But before we go any further, if you want to keep up with Nvidia's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates.
John, welcome to you. Let's start with what could kind of constrain the growth story. What do you see?
Yeah, I think they're going to report very strong earnings, but I think there's going to be some limits in terms of how much upside they're going to be able to post on the guidance. I think there's a number of factors there. With their current generation Hopper GPU, we think there are constraints in the China market. China is really pushing the hyperscalers in the China market to use more domestic solutions. There is a China compliant SKU, the H20 in that market, that's probably going to get pushed out a little bit in Q4. Customers obviously are transitioning to Blackwell. Blackwell is their next generation GPU. It's ramping right now. So some of these customers are opting to push out their orders for Hopper in exchange for Blackwell. And then lastly, from a supply chain perspective, we think Nvidia recently made a decision to switch their power management IC vendors. And I think that's creating some near-term bottlenecks from a supply issue, which could limit how many of these new GB200 NVL server racks they could ship in Q4.
Yet Jacobs did not limit his insights to cybersecurity alone. His analysis expands to cover a comprehensive array of infrastructure essentials required for AI's progression. Envision technology not just as abstract binary code floating in the digital sphere, but rather as rooted in concrete establishments, power grids, sophisticated chips, expansive data centers, and stable connectivity, foundations that invigorate the AI universe. BlackRock's perceptive strategic planning has pinpointed the investment potential within these so-called physical non-ethereal entities, offering a persuasive narrative that encourages investors to diversify their portfolios. Extending beyond the well-known tech juggernauts, consider BlackRock's very own iShares Future AI and Tech ETF, ARTY, and iShares AI Innovation and Tech Active ETF, BAI, as prime examples. These ETFs, which boast an impressive annual increase of around 13%, epitomize the perks of being ahead in the AI evolution race. Their performance mirrors a broader investor sentiment keen to claim a portion of the AI and its ancillary infrastructure's growth. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
So I'm trying to figure out whether we should really game out what could happen with earnings, John, from your point of view, or whether we should look longer term, ignore the noise of this week, and try to figure out where this stock's going to be in 6 months' time.
Yeah, I believe that most investors should look through some of the near-term noise here related to earnings. I think Nvidia still remains extremely well-positioned to grow outsized earnings next year. Our numbers for 2025 are well above consensus. Blackwell represents a pretty significant upgrade cycle because they're going to be shipping much higher ASP server rack solutions versus simply shipping GPU cards.
And I'm seeing here those figures that you're referencing. So again, there are your price targets, 180 on Nvidia right now. What about the rest of the space? I mean, do we even talk about Supermicro?
Supermicro obviously is a customer of Nvidia. We like several of the other AI chip vendors in the space, namely like an AMD and a Marvell. This is still a very expansive space. And, more than one vendor stands to benefit from AI chip growth.
As we stand poised at the dawn of 2025, investing in AI-centric domains of cybersecurity and infrastructure seems far less akin to casting a speculative bet and more comparable to making a calculated stride into a promising frontier. BlackRock's ARTY and BAI ETFs are emerging as intriguing opportunities within this rapidly developing sector, perfectly resonating with Jacob's perceptive insights that there is indeed more than just pie-in-the-sky potential here. The forecasted trajectory for these stocks suggests a robust upward growth parallel to AI's swift advancement. Current market valuations render these stocks appealing not only to seasoned investors, but also to inquisitive newcomers eager for a stake in this evolving narrative. The vast landscape of AI and its tangible infrastructures is expansive, and joining this unfolding story could promise significant financial returns. So, what do you think of this shifting paradigm? Are you considering an investment in the infrastructure and cybersecurity sectors for your 2025 portfolio strategy? Let's kick off the conversation as we navigate this exciting financial frontier hand in hand. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.